Welcome to a deep dive.
Great to be here. Today, we're really getting into the nuts and bolts, looking at how businesses perform.
Yeah, we're digging into financial analysis, specifically using ratios and percentages. We've got a whole stack of sources here.
And the idea is to, cut through some of the complexity.
Exactly. We want to unpack these key financial measures, understand what they actually tell us.
And why knowing this stuff is so important, not just for exams like ACCA, but really for anyone interested in, how businesses work.
Right, for understanding their financial health, their efficiency.
So by the end of this, you should have hopefully a much clearer picture of these tools and what the numbers really mean.
Okay, let's jump in. When we think about business performance, I guess the first thing that comes to mind for most people is profit.
Absolutely. Profitability. It's fundamental. So the first group of ratios we'll look at are these profitability ratios.
Right. They tell us how good a company is at actually making money.
Which is essential, for rewarding investors who took the risk and for having funds to reinvest back into the business.
Okay, and our sources highlight a few key ones. Return on capital employed, ROCE, return on equity, ROE, operating profit margin,
asset turnover,
and gross margin. Let's start with ROCE and ROE, the return ones.
Okay, ROCE, return on capital employed. It's a big one. It looks at the profit before you take out interest and tax. PBIT.
PBIT, right. Profit before interest and tax.
Yeah, and you compare that profit to the total long-term money invested in the business. So that's shareholders' equity plus long-term debt.
Of a long-term funding.
Exactly. It's asking. For every dollar of long-term capital tied up in the business, how much profit is it generating before paying lenders and the tax authorities?
And ROE, return on equity, is a bit different then.
It is. It focuses just on the shareholders. So for ROE, you use the profit after interest and tax the bottom line profit that actually belongs to the owners.
Okay.
And you compare that to just the shareholders' equity part of the funding.
So it's really zooming in on the return for the actual owners of the company.
Precisely. How much bang are they getting for their buck?
So for both ROC and ROE, the basic idea is a higher percentage is generally better.
Generally, yes. You want to see a good return compared to, say, just putting the money in a safe investment or compared to what competitors in the same industry are achieving. It's all about comparison.
Makes sense. Okay, next up, operating profit margin. This sounds straightforward.
It is, pretty much. It's your operating profit that's profit from the main business activities before interest and tax again.
Right.
Divided by the company's revenue or sales, expressed as a percentage.
And what insight does that give us if it's high versus low?
Well, a high operating margin could mean a couple of things. Maybe the company can charge premium prices, strong brand, unique products, something like that.
Oh.
Or they're just really good at controlling their core operating costs of goods sold, and things like selling and admin expenses, overheads.
And a low margin suggests the opposite. Maybe tough competition, pricing pressure.
Or costs are running high relative to sales. Yeah.
Okay. Then there's asset turnover.
This shifts the focus a bit, doesn't it?
It does. Asset turnover isn't about profit margins directly. It's about efficiency. It measures how effectively the company uses its capital, employed that same total long-term funding figure we use for ROCE to generate sales revenue.
So how many dollars in sales do you get for every dollar of capital invested?
That's it. And usually higher is better here too. It suggests you're working your assets hard to bring in revenue.
But you mentioned something about over-trading. Can it be too high?
Yeah, that's a potential downside. Over-trading is when a company is trying to do too much business, generate too much sales volume for the amount of capital it has. Can lead to cash flow problems, struggling to pay suppliers, that kind of thing. So efficiency is good, but you need the financial structure to support it.
Right, a balancing act. Now, the really interesting bit is how operating profit margin and asset turnover connect back to ROCE. Yes. This is key. It's not just a coincidence. Mathematically, ROCE is actually the operating profit margin multiplied by the asset turnover.
How does that work?
Well, think about it. Margin is operating profit divided by revenue. Turnover is revenue divided by capital employed.
So when you multiply them, the revenue cancels out.
Exactly. Leaving you with operating profit divided by capital employed, which is the formula for ROCE.
Okay, that's neat mathematically, but what's the practical insight?
It's huge for analysis. It means if ROCE goes up or down, you can dig deeper. Why did it change? Was it because the company improved its profitability per sale, better margins?
Or did they just manage to squeeze more sales out of the same asset base, better turnover?
Precisely. Or maybe a combination of both. It helps you diagnose the driver of the change in overall return, You see this often in retail, for example.
How so?
Supermarkets often have quite thin operating margins, lots of competition, but they shift stock really, really quickly. High asset turnover.
So their ROCE comes more from the speed and volume, less from high profit on each item.
Exactly. A different business model might have high margins but lower turnover. Understanding this breakdown is crucial.
Very useful. Okay, last one in the profitability bucket, gross margin. How is this different from operating margin?
Gross margin is a bit narrower. It looks only at the profit from the absolute core trading. So revenue minus the direct cost of sales.
Cost of sales being things like raw materials, direct labor, the cost of the actual thing being sold.
Right. It's calculated before you take off other operating expenses like marketing, R&D, head office costs.
So it's like the first slice of profit off the top?
Kinda, yeah. It tells you about the basic profitability of the products or services themselves, separate from the overheads of running the wider business.
And what does a high or low gross margin suggest?
A strong gross margin points to either good pricing power relative to those direct costs, or really tight control over the cost of goods sold. A weak one suggests maybe input costs are rising faster than prices, or there's intense price competition forcing prices down, a very direct measure of trading performance.
Okay, that covers profitability well, but making a profit on paper doesn't mean you can pay this month's bills, right?
Absolutely not. Which brings us neatly to liquidity ratios. These are all about the short-term financial health.
Can the business meet its obligations that are coming due soon, within the next year or so?
Exactly. Survival often depends on liquidity, even if you're profitable long-term.
And the two main ones we see are the current ratio and the quick ratio, also known as the acid test.
Let's take the current ratio first. It's probably the most common liquidity measure.
What does it compare?
It compares total current assets, things like cash, accounts receivable, money owed by customers, and inventory.
Stuff you expect to turn into cash within a year.
Right. It compares those to total current liabilities, debts due within a year, like accounts payable, money owed to suppliers, short-term loans, overdrafts.
So assets that will soon be cash versus liabilities that will soon need cash.
Simple as that. Does the company have enough short-term resources to cover its short-term debts as they fall due?
You often hear benchmarks like a ratio of 1.1 or maybe 2.1 being good. Is that reliable?
Not really, no.
Yeah.
It varies massively depending on the industry and the specific business model.
Oh.
Yeah, a business with very predictable cash inflows and low inventory, maybe a subscription software company, might be perfectly fine with a current ratio just above 1.
Whereas
a traditional manufacturer holding lots of raw materials and finished goods might need a ratio closer to 2.1 or even higher to feel comfortable. There's no single right answer. Context is everything.
And is it possible to have too much liquidity? Can the current ratio be too high?
Definitely. A very high current ratio might look safe, but it could actually signal inefficiency.
How so?
It might mean the company is sitting on excessive cash that's not earning a decent return. It could be invested better. Or maybe they have way too much inventory piling up, risking obsolescence.
Or perhaps they aren't making good use of short-term credit from suppliers.
Exactly. Cheap finance they could be using. So too high isn't necessarily good. It suggests poor working capital management.
Right, it's about balance.
Yeah.
What about the quick ratio, the acid test? It sounds stricter.
It is. It's calculated very similarly to the current ratio, but with one key difference. You exclude inventory from the current assets.
Why exclude inventory?
Because inventory is often the least liquid of the current assets. You have to sell it first, maybe on credit, and then collect the cash. It can take time.
So the quick ratio is asking, can the company meet its immediate liabilities using only its most liquid assets, cash and receivables?
That's the idea. It's a tougher test of immediate solvency, but again, context matters. You need to look at it alongside the company's operating cash flow.
Ah, okay. If they generate loads of cash consistently.
Then maybe a lower quick ratio isn't such a worry. Strong cash flow can make up for weaker balance sheet liquidity ratios sometimes.
Got it. So we've looked at making money and paying short-term bills. What about how efficiently the business uses its resources in day-to-day operations?
That brings us to activity ratios, sometimes called efficiency ratios or working capital ratios. These look at how effectively the company manages key operational assets and liabilities involved in its trading cycle. Think inventory, receivables, payables.
How quickly things turn into cash, essentially.
Very much, yeah. How well they manage that cycle.
And we're focusing on 3 main periods: receivables collection period, inventory holding period, and payables payment period. Let's start with receivables collection.
Okay, this measures, on average, how many days it takes the company to collect the cash after making a sale on credit.
How do you calculate that?
You typically take the average amount owed by customers, trade receivables, and divide it by the total credit sales for the year, then multiply by 365 days.
The source gave an example. Average receivables of $20K on annual credit sales of $40.
Right, so $20K, $40K is half. Half a year is about 183 days. That's the average time it takes them to get paid after making a sale.
183 days. Wow, that sounds like a long time to wait for your cash.
It can be. From a pure liquidity point of view, you want this number to be as low as possible. Faster cash collection means less money tied up, less risk of bad debts.
But is there a downside to collecting too fast?
There can be. If you push customers too hard for payment, you might damage relationships or lose sales to competitors who offer more generous payment terms. It's a commercial judgment.
Finding that balance again. Okay, inventory holding period. How long stuff sits on the shelf?
Basically, yes. It measures the average number of days inventory, whether raw materials, work in progress, or finished goods, is held before it's sold.
And again, for liquidity, shorter is better, less cash tied up.
Generally, yes. Less cash tied up in stock, and also less risk of the inventory becoming outdated, damaged, or obsolete.
But you need some inventory, obviously.
Of course. Run out of raw materials and production grinds to a halt. Run out of finished goods and customers go elsewhere. So holding too little inventory is also risky. Efficiency versus operational needs.
Right. And the third one, payables payment period. This is about how long the company takes to pay its bills.
Exactly. The average number of days it takes to pay suppliers for goods and services bought on credit.
How's that usually calculated?
Ideally, you'd use average trade payables divided by annual credit purchases times 365. But often, the credit purchases figure isn't readily available in published accounts.
So what do people use instead?
Cost of sales is often used as a reasonable proxy for purchases, although it's not perfect.
Now, from the company's own cash flow perspective, taking longer to pay seems better, right? Hold on to your cash.
It definitely helps the company's own liquidity. It's like getting an interest-free loan from your suppliers.
There is always a but.
There is. Stretch your suppliers too thin, pay them too late, and you risk damaging those relationships. They might stop supplying you, demand cash up front, or just give preferential treatment to other customers who pay faster.
So these three receivables days, inventory days, payables days, they all interact, don't they?
Absolutely. They define what's called the cash conversion cycle.
Oh, okay.
Think about it. You buy inventory, start of inventory days. You hold it, then you sell it, start of receivables days. Then you collect the cash. The payables period offsets some of that cash tied up.
So the total time from paying for inputs to getting cash back from customers, adjusted for how long you take to pay suppliers.
Exactly. And managing that cycle shortening inventory and receivables days, maybe lengthening payables days carefully, can free up a huge amount of cash in the business. It's a really powerful area of focus.
That makes a lot of sense. Okay, let's shift gears now to the longer-term picture. How the company is financed, its overall risk structure, gearing ratios.
Yes, gearing, sometimes called solvency ratios or risk ratios. These look at the mix of funding, how much comes from owner's equity versus how much comes from borrowing debt.
And this tells us about long-term financial risk.
Primarily, yes. It helps assess the company's ability to meet its long-term debt obligations, paying interest, and eventually repaying the principal.
We're looking at a couple of ways to measure capital gearing, debt-to-equity ratio, debt-to-debt plus equity, and also interest cover. Let's start with capital gearing.
Right. These ratios, like debt to equity, directly compare the amount of borrowed money to the amount of owner's money in the business.
What's the fundamental risk associated with debt compared to equity?
The big difference is obligation. Interest payments on debt and the repayment of the debt itself are legal obligations. If the company can't meet them, it could be forced into insolvency.
Whereas dividends paid to shareholders
are usually discretionary. The company can choose not to pay dividends if times are tough, without facing legal action from shareholders. So more debt means more fixed financial commitments, which increases risk.
So why take on debt at all? Why not just use equity? It seems safer.
Well, there are good reasons. Firstly, debt is often cheaper. Lenders expect a lower return than equity investors because they typically have more security to get paid first if things go wrong.
Okay.
And secondly, there's often a tax advantage. Interest paid on debt is usually tax deductible, reducing the company's tax bill. Dividends paid from after-tax profits aren't. This tax shield makes debt even cheaper on an after-tax basis.
So used wisely, debt can boost returns for shareholders. But how much is too much? Is there a rule of thumb for high gearing?
It's tricky, and like liquidity, it really varies by industry. Companies with lots of valuable physical assets, property, plant, equipment, can usually support higher levels of debt because those assets can be used as security for loans.
Like utilities or manufacturing firms.
Exactly. A tech company or a service firm with fewer tangible assets might find it much harder to borrow large amounts and will rely more on equity.
But is there any general guideline?
A very broad rule of thumb many analysts use is that gearing starts to look high, maybe worryingly so, when total debt becomes greater than total equity. So a debt-to-equity ratio over 100%, or a debt plus equity over 50%. But again, it needs context.
Understood. Finally, interest cover. This sounds like it connects profit back to the debt burden.
It does, directly. Interest cover, sometimes called income gearing, measures how many times the company's operating profit, PBIT again, covers its annual interest expense.
So operating profit divided by interest payable.
That's it. It's asking, does the company generate enough profit from its operations to comfortably pay the interest on its debts?
And here, higher is definitely better.
Absolutely. A higher interest cover figure means there's a bigger safety margin. The company's profits could fall quite a bit, and it would still be able to meet its interest payments.
Is there a safe level?
Again, it varies, but you absolutely need it to be above 1 just to cover the interest. Many analysts feel more comfortable when it's consistently above, say, 3 times. It suggests a reasonable cushion.
Wow, okay. We've really covered the main categories then. Profitability.
Yep. Can it make money?
Liquidity.
Can it pay its short-term bills?
Activity or efficiency.
How well does it manage its operational cycle?
And gearing.
The long-term risk profile from its financing mix.
It really feels like using these ratios gives you a much more rounded view of a company than just looking at, say, the profit figure.
Definitely. It's a structured way to dissect the financial statements and understand the different dimensions of performance and risk. They help you see behind the headline numbers.
And as we said at the start, these aren't just theoretical concepts. They're practical tools used every day in the real world.
Absolutely. For investment analysis, for credit assessment, for internal management reporting, for benchmarking against competitors, they're fundamental.
They let you ask smarter questions, compare companies more meaningfully.
Get a much richer understanding, yeah.
So thinking about all this for you, the listener, consider how knowing about these different angles, profitability, liquidity, efficiency, gearing, might change how you look at a business you encounter.
Yeah, maybe a company you invest in or work for, or even just read about in the news.
Instead of just hearing profits are up, maybe you'll start thinking, okay, but how? Was it margins or turnover? And what happened to their liquidity? How's their gearing looking?
It encourages a deeper level of inquiry, doesn't it? Looking beyond the surface.
Exactly. So here's something to ponder. What hidden strengths or potential weaknesses might you uncover in a company if you started applying these different ratio lenses, looking beyond the obvious headlines? What surprises might be waiting in the numbers?